My name is Ben Westra, and I will be discussing stock options and how to utilize covered calls. My name is Ben Westra, and I will be talking about stock options and how to utilize covered calls. Now, before we start getting into covered calls, we'll have to talk about what actually is an option. So to start, a stock option gives an investor the right but not the obligation to buy or sell a stock at an agreed upon price and date. This comes from James Chen from Investopedia. Now, options can be purchased through a brokerage just like any stock would. And they can add income, protection, and leverage against your other investments. There really are two types of options that you can buy or sell. They're calls and puts. Before I get into calls and puts, I want to give you a couple definitions that will help you understand the presentation a little better. So first is strike price. Now, strike price is the price at which you agree upon before and the buyer can purchase or sell those 100 shares of stock. The expiration is the date at which the option contract expires or those shares are converted into stock. Now getting into a call option. A call option is the right to buy 100 shares of stock at a specified price on or before the expiration date. And a put option is the right to sell 100 shares of stock at that strike price on or before the expiration date. Now, if you're wondering where those 100 shares of stock come from, that would be the contract multiplier. Within any options contract is generally going to be 100 shares of stock traded. So that will be the contract multiplier. So if you see an options price for 50 cents, using the multiplier, it's actually going to have a $50 value. Now, call options specifically have both a buyer and a seller. When you are the buyer, you buy the right to buy 100 shares of stock at the call strike price at or before the expiration date. Now, you're going to profit if the stock price rises over the strike price, and then you exercise your call to buy that stock below market value. Now, if you're the seller of that stock, of that covered call, you are hoping that the stock price declines because you have the obligation to sell 100 shares of stock at the strike price if the buyer exercises the option. Now, however, if the stock stays below that strike price, you're going to keep all your stock and the premium that the buyer paid you for the option contract. Because of this, the call option will increase in value when the stock price increases and decrease in value when the stock price decreases. Just like on the opposite hand, a put option has both a buyer and a seller, but the buyer buys the right to sell 100 shares of stock at that strike price before expiration date to the seller of the option. Now, they will profit if the stock price decreases below the stock strike price, meaning that they will be able to sell the stock for above market value to the seller of the option. Now, the seller, on the other hand, has the obligation to buy those 100 shares of stock from the buyer of the contract at the strike price if they exercise it. They're going to profit, however, if the stock price stays above the strike price, and then they just collect the premium without having to actually buy 100 shares of stock. I know this could all be a little bit confusing, so we are going to get into the more conservative way to invest in options with selling covered calls. So covered calls are a conservative yet effective way to add extra income and improve investment returns. That's according to Alan Farley from Investopedia. When I was talking to Professor Farr during the interview about call options, he called covered calls the most conservative form of options trading. Now, when you're running a covered call, you are going to be the call option seller. So if you think back to that table I had, you're going to be the seller of this situation. You also, making it a covered call, it means that you have ownership over those 100 shares of stock. So you already own 100 shares of stock, and now you want to write an option against it. You're going to be selling your right to sell your stock to somebody else for the short period of time, and that buyer is going to pay you a premium for the right. No matter what happens, you're going to get to keep that premium, and that's going to be money in your pocket. Now, however, if that stock does rise above the strike price, you're going to have to sell all 100 shares of your stock to the buyer at that price. Now, there are two ways that a seller can really utilize selling a covered call. So if a stock price increases but not past the strike price, I kind of wrote out a little scenario here to help you kind of understand what this would look like. So say on January 1st, you purchase 100 shares of Ford stock for $9 a share. You, however, do not think that Ford stock is going to rise up all that high in the next 2 months. So you sell a call option for 50 cents a share that expires in 2 months on June 30th with a strike price of $11. So you do not think that Ford stock will rise past $11. Now, on June 30th rolls around and the price closes at $10. And since it's below that strike price, no one's going to exercise their option to buy it higher than market value. The next day comes around and you're going to profit that $50 premium that you received back in January from selling your call, and you keep your stock, and you also got a capital gain on your stock while your shares increase in value over time. Because of all this, your total gain is now 16.6% with your covered call, whereas if you would have just held the stock, you would have only gained 11%. Another way that selling a covered call can really help you during your investments is when the stock price is going to decrease. So with the same situation, I built out another scenario, or on January 1st, you buy 100 shares of Ford stock for $9 a share, but then you think that the stock price might not actually go up to 11, it'll actually decrease over the next 2 months. So you sell a call option for 50 cents a share, expires on June 30th with a strike price of $11. Now when June 30th rolls around this time, the stock closes at $7 a share. So the option to buy at $11 is not going to be exercised, obviously. You then will keep that 50 cents per share, so you get that extra $50 in your pocket without having to sell your stock. You're still going to be a holder of Ford while your stock has decreased in value $2 per share. This way, as your investment still lost money overall, you lost less money. With the covered call, you only lost 17% in value, while with the cover without, you would have lost 23%. So this is another way you can help hedge your investments. If you think that one of your long-term holdings is going to decrease over time, you can try and stop some of those losses from being so great. Now, along with that, I wanted to show a real example of a covered call that you could execute right now. Say you were a long-term holder of Apple stock. Apple currently trades at $278. So if you were a current long-term holder and you had over 100 shares, you could execute a covered call against them. I decided to look out about 2 months in the future, so I looked at June 19th, and I found a call option with a strike price of $300 that would pay you a premium of $5.85 per share. So looking at this option chain here, it can be a little confusing, so I put some arrows in there to point out the strike price of $300. Now, especially with all the whole coronavirus situation, the stock market not looking great, it does not seem like Apple will be gaining $20 per share in the next 2 months. So I chose a rather conservative strike price of $300, but that also still pays us a pretty high payout of $585 per share. Now remember, since we have to use that contract multiplier of 100 shares, we're actually going to get paid out $585 for selling this covered call. Now, as long as Apple does not rise to above $300, we're going to get to keep our $585 without losing a bit of our stock. If, however, it would rise to $300, we're only going to be able to profit up to there plus the money that they paid us. This is ultimately the downside, and this is important to note that there is a downside to selling covered calls. Now, if we lose out on our position in the stock, we're going to lose out on our seemingly unlimited profits. If you hold a stock, there really is no limit of how high the stock can go. So you can really reap those benefits for years to come. Being taken out of your position can hurt you in the long run. This is best utilized when a stock is overvalued. This is something Professor Farr definitely touched on, is that when you think a stock is overpriced, they will eventually come down, and this is the time to execute a covered call against that stock. Now, to wrap it all up, options are really a good way to hedge risk and add extra income when you're investing. Now, selling covered calls is a conservative yet effective way to trade options. Selling covered calls does have both its advantages and its disadvantages, but with the right stock at the right time, you can generate income and reduce your average cost to invest.